So, hello everyone. Again, uh, there was an issue with my PC. I don't know, it just freezed and I couldn't do anything. So I had to reboot my PC and I'm able now to share again. And yes, sorry for these issues. That should not be our standard here. And so, okay, I don't know, but hey Karim. So all right, looks like it's working now. Yeah, just quickly double check for me. Okay, so 1 second. Okay, yeah. Okay, how is it now? Just refresh and then, okay. Yeah, okay, all right, perfect. Yeah, so I'm just moving here. I hear my voice, so it should be working now. What is not showing? Okay. Um, yeah, it is. It is lagging. I think 5 seconds or something, and so yeah. All right. Okay. Cool. So yeah. Sorry again for these issues. So this private now. Yeah. Now it's working. Refresh, please. Should work now. Okay. So it's not lagging. Just 5 seconds. The regular lagging. But you could see my screen and hear my voice, and everything is okay, right? Okay. Perfect. Yeah. So again, guys. The last time I stopped, I think, was here on the wheat future, where I just explained you the spread trade. And I don't know where it stopped, but the thing is with the spread trade or with the spread traders is that you can trade different contracts in one asset because wheat, the future, has for different month different expiries, so different contracts, and each contract you have to see like an own asset. So if I go, for example, here in wheat future, then you see this is something I didn't show you a few minutes ago. So um, if you go in the wheat future, you see that you have a December contract, a March contract, a May contract, a July contract. Actually, we can also bring all these contracts in one chart. So let me just click on the wheat December 2024 contract here. Boom. And there you see that we are here currently at 536 and 40 cents per bushel, because the price you see here, US dollars or USX per bushel. And okay, so if I now overlay the next contract, for example, for wheat future, the next one here, March, as you know now from the future, and if wheat is in a normal state um, in the future market, so the March contract for 2025, should this be higher or lower than where it is now? Actually, it should be higher. So let's see if I put it on the same scale. What do we see? Let's make this regular. Here you see now that the magenta or red line here is the future contract here for wheat for March 2025. It is at 554. The December contract is at 536. So what do we have here? The future contract is higher than the current price. So is it contango or in backwardation? Let me just quickly draw it like this. So we start here with the current price and the future price is higher. So easily said, just based on these two contracts, we are in contango. So if I subtract the current price from the future price, then it would be positive and would mean we are in contango. Now, if I overlay the next contract, let's take May 2025. And here is also something what you should recognize, that we have not a contract for every month. So we have December, no January, no February, then March is the next one. Then we have no April, but May. Then we have no June, but July. And this depends from future to future, from commodity to commodity, if there is a contract for every month or just with just with some specific month in the year. Yeah, it's like I said, it is different from commodity to commodity. So when I put on here the July contract for 2025 on the same scale, it automatically goes here in percent and shows you the difference here from the beginning. But we want the regular pricing. The purple line now is the contract for June next year. And what do you see here? That is at 570. So that means our next contract is again higher than the current contract. So everything looks fine. And here you just directly see that they are pricing in like the insurance for the silos, also like interest rates, because yeah, we are in the positive territory there, and so on, and storage costs whatsoever. And that causes that the future prices are higher than the current prices. What will happen, but over time, is when you now lock in this March 2025 price here, then you actually get wheat delivered if you want to get it delivered for this price in 2025. Yeah, what will happen over time is, of course, that the price will move up and down. Okay. And so if you just bought the wheat price for this this specific price level here, and the price goes up, you would be happy. But what does happen when the price then falls down? And let's say your last day or your day of delivery is here, then you actually pay too much, because you bought wheat for this price in the future, and because you need wheat for your production or for your company whatsoever. And now you could buy actually wheat for less in the spot market. So I will just immediately read your question, Karim, 1 second. So what you will probably do is, if you lock in today here at this day the current future price for wheat for March 2025, what you can do is, because when you buy the wheat price, you are actually long the wheat price. Because if it goes up, then you are happy that you get wheat for this price, and you can immediately go in the market and sell it for the higher price. What will you make? You will make profits. Or actually, if you like I said, if you are a producer of something like Kellogg's or something, then you will be able to take your consistent prices on your Kellogg's, and you will be happy that you bought the future here, because otherwise you would have to pay much more in the market. But because we don't know what will happen in the future, what professionals actually do is that they immediately, when they buy this future, they will also that means they are long, or you already have wheat maybe in your silo, and you go the same price then short over another future, or maybe in the same future. Maybe you take a further out price. You can go maybe the July 2025 contract short. Now what will happen is that when we reach the price here, then you will make this price also will probably come down, or these both prices will come closer, and you will make money on this one, and would have this delivered to wherever you want. Okay, so that is how future spread traders are trading the market. Now let me quickly just read the question here. What I don't get in these future charts is when you are showing a June chart, for example, I would expect to see the prices until June, but the timeline is the same as for December, for example. That's confusing. I know. So you see that we have here actually pricing for every contract. So even now, or even in the past, I mean, we can now also trade the wheat future in 2026 and 27. You see? So every day this future price is changing, how you see it here. So that's why you see for every contract the same price action, but actually it would be a difference. The difference is which price you lock in for the future. I mean, you will see this is now a line chart, but let me quickly go into the chart for wheat. Let's say March 2026. So now you see that every day now the price is also trading here. But is this liquid? No. You don't have so many people who are trading the wheat price for 2020. What is this now? What did I say? March 2026. So 1.5 years. But obviously around May, June, a lot of people bought the wheat future here. And same also for winter. And so you see already here a cyclical price action in wheat in the summer and in the winter. Okay? And that is the reason for that. I mean, we can go, for example, into wheat future March 2027. Here, you see obviously not many people, just a few people, whoever traded these prices, but you don't have any clean price action here. So it was just a few specific prices which were traded here. But if we go into the current future price, the December, this is the price action there. And so this, or the future prices, also depend on the currently traded prices in the market. I hope that makes it a little bit clearer. And that is what you have to understand, because of course the current price or the future price for in 1.5 years is depending on the currently traded price in the market. And that's why you will always see in the other future prices the more or less same price action, just a little bit shifted to the upside, because of the reasons you learned in the lecture, like storage cost, insurance, delivery costs, blah blah blah, all these things. But that's also why you can now hedge yourself against price fluctuations in the future or upcoming price actions. Okay, so if we would have, for example, a demand shock, and you need wheat in 6 months, and you lock in this price here for 6 months, or let's say here this is your expiry date. Oops. So here, whoop, yeah. We never know what will happen in the future. But you need this stuff here, and maybe the current price of wheat is cheap for you. Then you can just take this future and say, okay, whatever happens in the market, in March 2025, I want wheat for the price of 551. And if the price comes down, let's say the price falls down, you are still happy with this price, but because you need wheat again in the next month or next 6 months, you go into the market and buy wheat here. Then if you buy wheat here, you are again long wheat because you have it. And if the price rises, you are just happy with it because you locked in this cheap price, or maybe you will be able to sell it in the market if this, for example, goes up here, and you keep a little bit because you need you just need a price, you just need a specific amount, and you can sell then the rest in the market. So I know it's a little bit confusing and difficult, but it is a very important concept that you understand this future price reactions. Let's go into oil, for example. That was also something what I explained in the first try of our streaming here. And let me quickly take out these prices here. So what happened in 2020 when the oil price just fell down to minus 40 at its peak, at its lowest point? So not everybody wants to get the commodities delivered to their company or to their home. I don't know for what area. But the thing is, many people now in the market, like also me, are just trading the price action. I want to take advantage from falling or rising prices in the crude oil future. Because why is the future market also so interesting? It is actually a leveraged market, and it is a quite quite fair market, and you have a lot of resources actually to analyze the future market or the commodities. And so a lot of people are here in the future market and just trading the oil price, like me. And here in just during the Corona crisis, there were some news that maybe we have to slow down our economy, or maybe ships will not or planes will not fly anymore. There was news about a lockdown, probably, blah blah blah. But it was quite sure then around these dates here. And the oil market just came down. And there are not only us, like retail traders, trading the crude oil market, there are also institutionals who are trading the crude oil market and taking advantage of the leverage in this asset class. So a lot of people just panicked during this time because they had open crude oil contracts. And if they keep this contract open till the expiry date, which was here, the 21st of April 2020, they will get oil delivered. And each oil contract actually consists of one, so contract size is 1000. So for each contract, you get 1000 barrel, you see it here, BLL. Yeah, so this is here also you see the contract specification. So we are trading in US dollar and we are trading it in barrel. I mean, this could be interesting. You can trade crude oil here in hectoliter. Yeah, so you see it will change. You can trade it in bushel. So this way you would see the price against wheat maybe. So this would be important for intermarket analysis. But anyway, we trade crude oil in barrel. And so 1000 barrel costs you $67 times. So this would be 1 barrel, the price for 1 barrel. And you are trading here 1000 barrel. So this would be something around 67 times 1000 would be 670,000 per contract, what you have to pay. And if you are trading several contracts, you can imagine how many barrels you have to buy if you are in the contract and get the delivery. And during this time, all storages for oil were full. They even stored oil in the delivery boats, yeah, like the big tanks on the boats, because everything, Cushing, Oklahoma, Western Texas, I don't know, every inventory every inventory where you could store oil was full. And they even paid for the tank, for the boats, for the tanks, they paid, I think, something around $40,000 per contract for oil. So it was very, very expensive to store oil these days. And it was cheaper for the guys to give you 10, 12, 30, $40 per barrel if you take the contract from them. Because why? I rather pay you $40 per contract to take this 1000 barrel from me instead of paying a fee to the CME or to pay or NYMEX where oil is traded. Yeah, what you see here at the top left. Or to store oil for $40 per barrel or per 1000 barrel on an oil tank. Okay, and this panic then in the market caused the drop in the oil price down to $40. What happened immediately the next day? We started here at $21. Okay, so everybody tried to get out of this contract and jump into this contract. And so I was just in front of my screen when it dropped here down to 2010 here at $5 or $6. I even thought about to buy crude oil contracts in the future. But even this day, every other contract also dropped. And so I would have would have lost a lot of money if I would have been trading crude oil here. So was the right decision just to do nothing and to step away from this meltdown. But then the next day, the future contract just started here at this price. So you see that this price was lower and here it was higher. And also for the next contract here, the price was higher and higher. So we were in a contango here. And so that to the situation. And actually, they say it was mainly a Chinese hedge fund who was in a long trade here in oil and who tried to get out. It was not only one fund, it was several. And this cascade of selling pressure just caused that the price dropped below zero, actually to minus $40. Yeah, so that's the thing. And here on crude oil, for example, you will see that we have a contract for December, January, February, March, April, so on and so forth. So you see that we have for each month actually a contract. Why? Because oil is a highly used commodity. Yeah, we need it for kerosene, for our planes. We need it for heating oil. What is actually a several contract, but it is made out of crude oil. We need it for our gas for our cars, so on and so forth. So crude oil is a very, very liquid. That's what he said. Very liquid commodity, and yeah, so that's why it is traded on um, every month. And yeah, so here also, but you can go and look for the crude oil contract for December. Is that what we are trading currently? Then you can say here for January, and what should we see actually? That this is higher than the current price. But interestingly, you will see, oh, the January contract is a little bit lower than the current price. Interesting. Okay, let's see how is it with the next contract, with February. Okay, so here we go, regular. Oh, you see that this is actually also lower than the current price. Here you see a difference, I hope, what we saw in wheat. Now you see that the current price, what is here, the spot market, that the current price is higher than the future prices. How do we call that? That is a backwardation. So the people are actually willing to pay now a little bit more for the crude oil they need instead of buying the future and getting the delivery in 1 month or 1 month or 2 months later. People who can wait for their delivery are an advantage now. But people who need oil immediately, like a gas station, or you need oil to heat your house or whatsoever, or also several companies like plastic producing companies, they need oil. It's the main ingredient for plastic oil, so they must pay the higher price instead of waiting for the future. And that's what we call a backwardation. And that is generally caused by a demand shock. So we need now oil more than we will need it in the future. That is the information you get from this future price. And so what would be an advantage here now is if you have the crude oil contract, and then you have to roll to the next month, because you know that the crude oil prices expire. So the next expiry is actually here on 18th November. And here's also a specific what you will see in the crude oil market, how you can actually trade it quite profitably. To be honest, I should do it also a little bit more. But what you will see is here are the contract expiries. Do you recognize some? Oops. Do you recognize something just close or before the contract changes or expiries? Not always, but very often what you will see is that the crude oil market comes down just before the expiry. Especially the last 3, maybe 4 days. Oil, I don't know, to be honest, actually why, but everybody is then rolling their contracts to the, at least at this date, around this date, to the next contract. But the oil price very, very often slows down, especially if it had a strong move before. The few days before the expiry, oil will come down. So here was a little bit before. So that's not a blind trade, but if you see a specific market structure also, or if you see a potential short here somewhere around there, then you could take the short with a little higher confidence. In this case, you also have to be aware of specific things in the oil market. Like we have every Wednesday the EIA numbers. So that's the Energy Association Inventories, EIA, or EAI. And they are showing the inventory numbers for crude oil. And of course, also we have a seasonality in crude oil. Actually, that is really cool here in TradingView now, that you can see the seasonalities of every asset here. So this is now for crude oil, but I can also go into Ethereum. This is actually level 3 stuff. But now a quick introduction to seasonalities. If you click here on more seasonality, you can actually, okay, they only have 4 years here for crude oil, but what you will probably see that generally around this time of the year, crude oil comes down. So crude oil has no strong rally when we come into winter. You will probably wonder, how can that be? Because in winter we need more oil because of heating. When do the guys do generally their job? Around the summer. Around the summer, the companies or crude oil, or companies who need crude oil, they buy it in the summer. That's why we generally see a rally of crude oil in around May to July or something. And in the winter, where everybody is using the crude oil, you will see a decline. And then the next year, you will see an increase in the price again, especially at the beginning of the year. Then we have a small drop down. And then in the summer, we see a rally again, and so on and so forth. And that's also something what you can see here in gold, for example. When do we have, let's say, percentage moves? You will see generally a rally in gold in the summer also. And here we only can see 4 years, sadly, but on some other assets you can have a longer seasonality. But what you will probably see is here, the green line, 2020, gold came down. 2019, gold came down. 2023, gold from November here came down. Okay, then it rallied a little bit earlier. 2022 and 21, okay, gold came a little bit down, but around this area here, mid of November till December, gold generally comes down. But where every year was more, we had a common sense. At the beginning of December, gold rallied up, rallied up, rallied up, rally up, rally up. So seasonality in gold is generally around December until March next year. You see, here we rally up, here it starts at 0 again. And what do you see? If we start at 0, then generally gold goes up. Here in 2021, it came a little down. Okay, can always happen. But generally, the seasonality of gold is up from December till March. And what you also can see here in TradingView now is the term structure. So you can see here the this is the implied volatility. So this is options stuff. This is also options, but you see here the forward curve. Yeah. So you see here for each contract in gold until 2029. But you see, are we in contango or in a backwardation? And you see that we are in gold in contango. Especially here, 2026, you see that the gold price is rising very strong in the term structure. So I would expect now that in 2026, we will probably see a quite strong move in gold, because the institutional traders are actually pricing in now higher prices in gold here, or is a really strong increase. Okay, so all right. So and this is also what you can see for other commodities, like here in oil. What do we see in the forward curve here in oil? There you see the current contract is much higher than the future contract. So we are actually in a backwardation in crude oil, what normally should cause higher prices. So there is, but in crude oil, there's this thing of yeah, so the economy is also playing into the crude oil price. Um, Trump just said drill baby drill, so he said he wants to be an oil exporter now for the next years. So he wants to deliver oil to the other countries. So yeah, that's why he will probably drill more oil, so we have a more supply. A higher supply generally means that the price will come down. I'm not sure. Actually, the crude oil price, okay, we are here at some lows. I'm very curious if we break now these lows, but at the moment I'm expecting actually that we see higher prices in crude oil, but you never know. So yeah, looks like in head and shoulders here, but this is just in the middle of the chart. So yeah, if we turn around here, that would mean that we have a big W with a head and shoulders in the middle, what would be actually a very, very strong long signal for me. It is like when we have an M in the middle of a W, or here this structure of a head and shoulder in the middle of a W, that would mean yeah, a very strong buy signal. Okay, yeah, so term structure and things like that. So let me quickly go into the Q&A document again, just to check if you have any questions. Okay. Yeah, so that was also a question here from the chat from Karim, and also a question here from Floris in the Q&A document. Can you please explain? Next question. Can you please explain us forward spreads? Yeah, I think I explained that already, but it is like what I mentioned. If you have now crude oil here for February 2022, January 2022. Why it doesn't show you the price? 1 second. CL. Or let's say, because the difference will be higher here. CLK is then for crude oil 2025. And we go here into regular. You see that the future price for next year, K is what again? March? Or what was it? May. Okay. So the May price for crude oil next year is currently lower than the price, what you also can see here. So this is the current price here at the top, and May next year, you see it is at 62.21. And so this was the last price here. It can change a little bit what you see here because of settlement and so on. But you see more or less that the price is lower. And if you just go, for example, the current price and short and the future price long, then you would have a spread. And what should actually happen is that both of these prices come together to a mid price, and you will probably win a little bit more on your long, or you will lose on your long and will win more on your short, and that is that what we call a spread trade. But at the end, if you go one short and one long, these both prices will come together. But then it depends, like I said, which was priced a little bit higher. And actually, you should make more money on your short than in the future than you make on your long. But yeah, that is what the term structure currently is telling us. So that the price should come down. That is, yeah. So that is what we are doing here on the forward, on the spreads, but on the futures. But you can do it also in the forward contracts. And as you know, the forwards are not cleared by a clearinghouse and is a OTC market and so on and so forth. Okay. So, all right. This spread trade stuff. Yeah, I mean, that is the main thing about that. If you still don't get it, just watch the video again. And otherwise, I can explain it next week or in the future. Yeah, pun intended. In the future again. And yeah. But I hope you understand the main concept now, what it is telling us. And where you can also, I think it's, Brian also shows now and then this site here, where you can go, futures tradingcharts.com. I will post it quickly here in the launch. Yeah, you're saying, I thought inverted head and shoulders is bullish and the normal one is bearish. You short the current price and long the future price. That's what you mean. Short the current, yeah. So to your question, yeah, short the current price and go long the future price. And yeah, inverted head and shoulder. Yeah, inverted head and shoulder is generally bullish, and a normal head and shoulder is bearish. But if this head and shoulder here, what we see, actually here also another shoulder, if this would resolve here bullish and will not break down, then we have a short structure which just get overrun or overwhelmed here by the bulls. And if you squeeze out all the short boys, they have to cover their short positions, and that would accelerate then the long. And that is something what you will see, yeah, always in the market, that if a short market structure doesn't play out, then I would be more bullish. Yeah, that is a sign for bullishness. Because as I say, they built up a short structure, but obviously they were not strong enough to make it through. So you have no follow through here in this short structure, and that would actually speak for more bullishness in the market. Yeah, and especially if you have a bearish structure in a bullish structure. So yeah, if you get a W here, boom, and then a retest of the neckline, that would be very, very bullish here for oil. And you see also here we have actually also here a little tilted head and shoulder, which played out. Okay, whoop. And we also have a head and shoulder here, which played out. So if these short guys, and you see also the fractality or the fractals in the market, here's also a head and shoulder, which played out, oops, which played out here. Yeah, whoop, retest, ready to go. Yeah, but if this doesn't happen, and you see from a big head and shoulder, smaller head and shoulder, very small head and shoulder, and you will see that very often in the market that these structures or price patterns occur 3 times, and after then you see a shift in the structure in the market. And actually, to be honest, that's what I'm expecting here. And what you will also see here probably is, let's see the retracements. And that is again the psychology, or actually the algorithm in the market, which is working here. So you see that the price came down here, had a retracement into the reload zone. Okay, let's see the next one. Oh, hello again. And so, yeah, this is not a head and shoulder, this is a double top. But then we had this third time here, the head and shoulder, which actually also played out here. Let's see. Okay, it was early. No, it was earlier here. Okay. Very close, like the other one. So it's not perfect, but you see again here, we came into the reload zone and sold off. So, but this head and shoulder is now a little bit bigger. I mean, this can play out. Don't understand me wrong. But I would just expect that we are short if we really break down here. Ideally, come back, and it can come back in far to the middle here of the head and shoulder. So ideally here, but it can also come back to this area. This is also a specific, market structure, and then it can go down. Okay, but like I said, if we will break the bearish structure, you see that the market actually is still in the mood of shorting, what also this tells us. But if the market now is breaking this short structure, that means the algorithm or whoever is in the market has finished its job, and now we have a shift in the market into a bullish mood again. Okay? That is what is happening here and what the price action is telling you. I'm done. Now we can go back into the other direction. To be honest, if I see these small higher lows, maybe we we see, and this would be also very bullish, if we see a small wick, boom, and then a candle, and then go up. Because then it takes out all the liquidity here from these guys. These guys are already taken out. Here, what I showed you in the past, you see we have a long wick. Let's take 50% of the wick. Template, equilibrium. Yeah, where it came back. 1 second here. Boom, boom. So, you see big wicks, yeah, and I call these naked wicks. We have here another one. So the lowest wick, and let's take 50% of this wick and go into the future. What happened? Yeah, you see it just nearly exactly to the tick. Just grabbed this liquidity here and then whoosh, rallied up. What did it do with this wick? Boom, it came into the wick and just rallied up. So this area here has a strong resistance, and this is also what I called in the volume profile, if you remember. Maybe some of you remember, how do we call these lows where we have a single print, and that's the reason this is a strong low. Yeah, we have a single print in the wick here in this candle, so this would indicate that this is a very strong low. At least we need 1, 2, 3 bars here, and yeah, so I would be very confident that this low will hold, and that's what it did here. And yeah, actually we need a very strong move down, but if we come down and if we get rejected and it comes back, then you could be pretty sure that this will initiate a way up. And what do we do if we see an initial move up here? Then I would draw my Gann levels and so on, and my Gann fan from this impulse move here. Okay, so all right, this quick analysis here to crude oil. Let's get into the Q&A. So can you explain how we can compare the spot price with future price over the time? For example, GC and XAUD. Okay, so I mean, you actually answered it already. So we take a GC, and then you add here with the plus symbol, you can add XAU USD, so gold in US dollar, and actually these should be very similar. And yeah, you see that the spot price, let's make this regular, is just nearly close, or is nearly the same price like the future, but like the name says, the future price is a little bit higher, and you will see that the future price is generally a little bit higher than the spot market. And yeah, that's how you can compare it. Of course, for better difference here, you can make this also a line chart, and this should be the normal situation, that the that the future price is above the spot price. But what you will, if you have the situation, and you see that doesn't happen very often, but if you see like here that the future price is lower than the spot market, guess what? This is then a spread trade what you can make. Okay, you can now, okay, this is a good example. Thank you for example. Thank you for the question. If the future price is lower than the spot price, that normally should not happen. But what you can do then is you go long the future from this point, long the future if you want to make a spread trade, and you short the spot market, because there is an inefficiency in the market. And what will happen then is what you see, I hope. So the future price, boom, rallied up. The spot market price too. So you would be here more or less plus minus zero. Then they shifted both down. But what happened then? The future price rallied up. And what happened at this point to the spot market? It was not so high like the future price. So at this point, you would make the profit in this spread. Thank you very much for this question. So you would make losses here on the spot market for 3.45%, and you would make gains of 4.9%. So the difference would be round about 1.41%, what you have here. Okay, so this would be a very risk-free spread trade you can make. And actually the advantage here would be also that the future market is leveraged. So you would have to put in a little bit more margin here, but you will actually also make much more money in the future market than you would make on a CFD or in the spot market here in the XAU. Of course, you can also just directly trade this over the currently traded future here in gold. But if you take the spot price like XAU, you see this very clear that you would have made money based on this trade. Yeah. And if it would go down, then you would make money on the spot price and would lose on the future and would make that money this way. But in this case, it was more likely that the future price overshoot a little bit too much to the downside and should go up. Very nice one. Okay, I hope that makes it clear. Again, what is a spread trade and how you can make money with a spread trade in the future market, and in this case in combination with the spot price. So spot price means you would be someone who owns gold or has to sell gold, and then go long in the future. And this was an analysis from me where I expected that the price come down, go up, what it did here, and then come down. Okay, anyway. So question number 4. What do we have here? Can you show us how to build the study of comparing the forward price in different time frames? Forward price in different time frames? Yeah, I think I showed you already over the different contracts you can choose, or actually like you have it here in TradingView now, that you have the contango or backwardation in here in TradingView at the side. And here you see that in the future they expect wheat to come up, and it can come down here. Should come down here. Okay. Then general non-topic specific questions. Do you have an indicator that signals or measures the extent in which retail has arrived the market, especially the cryptocurrency or the crypto market? We will get next week into that. Yeah. So actually that's what the COT report is for, to see the extent in the retail traders and the commercials or the producers in the market. So the difference between the retail traders and the professional or institutional traders. Yeah, I will skip this question for next week because your next lecture about commitment of traders report is exactly this question here. Okay. So the next question, if I recall well, you are specialized in macro market analysis. Yeah, more or less. Can you tell us how you analyze a potential market or asset that can be pumping up after a period of time? As Brian told us in level 1, the money is moving from a market to another. How we can best determine where the money flow is flowing, for example, in the next 2, 3, 5 years. For example, there are for sure people that were predicting the AI trend to happen and started investing in companies like Nvidia. Yes, actually, that is my like you said, my specialization. And what I use for that is the relative rotation graph. I just want to spoiler it a little bit, because you can go here on stock charts. Brian showed us stock charts in level 1 and far back in 2000 2017, and I thought, oh, well, this is an 1980 site. It looked a little bit different then. They just facelifted a little bit, but this site is very, very good. Even in a free membership, you still have access to a lot of stuff here. I have an extra membership because I use a lot of stuff, and with a longer period in the price charts and so on. But what you have here is actually here this cap weighted and equal weighted sector list. And so what I look for is how the sectors are moving. Maybe this would be a little bit too much. Maybe this put this question also in week 12, please. There I can go a little bit deeper into the market analysis of sector rotation or the market cycle. But what you should do actually is look how the sectors are performing at the moment. What you can do here on stock charts, and what is really, really cool, is that you can look here on the, let's say here on one asset, let's say XLK. Oh, no, not on sharp charts, on ACP. That is the advanced charting tool from stock charts. And let's have a look here. Okay, so here are screeners and whatsoever. But what you have here is you can also chart like any asset you want. But the cool thing here is that you have a sector summary here at the bottom. And that is a cool thing, where you also again have each 11 sectors and their performance. And what you can look here is now the intraday, or you can say, hey, show me the 1 month performance. So this is actually looking at a 1 month chart here for the sectors. And you can also look here on your communication services. Then you see the branches in the communication service sector. But 1 second, where was it again? Yeah. So you can also look here on the 3 month performance. And so you can look here now how the sectors just performed over the last 3 months. What would indicate, okay, where are the leading sectors and where are the lagging sectors? And depending on the performance here, and then on the price action, you can actually see, okay, where can I expect a shift? So you see that the healthcare sector over the last 6 months lost 6.77%. So this is a lagging sector, and which should maybe over the next month, 6 months maybe, should go up, or you can start a bottom picking here. Where I would not expect a bottom picking, more or less a shorting market, would be the XLY, the consumer discretionary sector, which gained 17% over the last month. Remember, the S&P generally gains 8 to 10% per year. So this is a strong and good performing sector. And then if you click on the sector, you see that you now could look into the specific sector for its branches here. So the sub-sectors, if you want. And you see especially the automotive or automobile sector rallied 43%. So you can look into the sector, what are assets here, which you can maybe short. This would be a way to analyze the sectors, and you can also have your chart lists, or you can go here, 1 second. Yeah. You can build also your own chart lists, and what I have here also, and like, where is it? ETFs. Yeah, you can here weekly the ETFs, and then you can here, right. If you go on chart list and you build, for example, a chart list with all the sectors, and then I also put in here the S&P and the VBINX, that is a Vanguard Balanced Index Fund, which is built out of 60% stocks and 40% bonds. Then you can see here just directly in one picture the 1 month, 1 day, 5 day, 1 month, 3 month, 6 month performance. And then you can also, let's say you want to filter it, who was the best the last 5 days, then it brings you up the best one in the last 5 days. And then if you click on 1 month, it will still keep the best one in the 5 days, but now overlays the 1 month performance. So you would have now the best in the last month. What you can do is look who was the best the last 6 months, who was the best the last 3 months. You see this stays the same. Then the last month, 5 days, 1 day. Now you have really that one sector which was very good generally over the time. Okay? Oh no, you see here it was XLF, obviously. Yeah, so then you can look at the chart and would see that XLF actually rallied quite high and is at, oops, it's a little bit slow, sorry. But you see that XLF is probably not something where we want to get a step in. And yeah, because it's at all-time highs. Could go a little bit higher for sure, but look and wait for market structure to short this. Another way to look at this, what I like and do sometimes also in addition to stock charts, is Finviz. You can go on Finviz free and go into groups, and here you can see it's directly here on bar charts. Then you see here the 1 day performance of the sectors. Also, this is filtered here with only with the sectors. And you see the last day, the utility sector was performing pretty well. And you see here that the weakest one was the technology. How was it about the last week, past month, 3 month, and half year performance? So you see over the past half year, actually the best performing sector was the financial sector, then followed by the technology, communication services. So if you are maybe an experienced trader and you see that the performance of these sectors is still holding, you see here half year financials again, financials here, okay. If you see maybe over the past week that the financial sector was a little bit weak, or over the past day, maybe, like I said, experienced trading. So this is a very, very strong bull market. You can look for retracements and short-term trades. Trade in the trend direction. Don't trade against the trend. And that is how you could maybe quickly analyze the market for the next 2-3 weeks, maybe 1 to 3 months. To be honest, I'm not a big fan at the moment, or I can't predict you the future for the next 2 to 5 years. But with that, you probably can say, okay, yes, since now what should be the performing for the next for the next period? I would look now for the healthcare, maybe also the basic materials sector, consumer defensive, because these were underperforming, and it is a cycle in the market, which you also can see here in stock charts. If you go on stock charts, I mean, this is all on video, you can watch this again, and you go on performance charts, and this is again, this is level 3 stuff actually. You go into the sector performance. Here you see all the sectors, how they perform. you can overlay here a cycle line. So look, okay, which are down, which are up, and then you go down here and analyze the market. Okay, at the top of the market, you see market cycle, what means the stock market, what is generally at the top, energy, materials, consumer staples. So if we are heading into a market top, you will see these sectors here better performing than the other ones. But what do we see currently? The financials, technology, discretionary, these sectors are performing. So we are currently, obviously, technically in a market bottom and should go higher. That is also actually my expectation. We are just moving higher. And when you see these sectors outperforming, then I would expect that we are at the market top. And then you have also, this is the bigger picture. You have also here some macro data, what you can analyze in the market. And you see here consumer expectations, industrial production, interest rate, and yield curve. And I have that already in my process and from public chart list. I will also share this list with you, because what you can see here is at the beginning, you see University of Michigan consumer sentiment. What is here? Consumer expectation. And you can look here now, it is reviving, rising, declining, falling sharply. You have to look at the price here. Is it falling, rising, or declining? You see here also the explanation if we are in a full recovery, early recovery, full recession mode. What you can also see here at the bottom, full recession, early recovery, blah. Would take too much now to explain this. Maybe in week 12 I can go into this again. But you can go over this chart list, and like I said, let me quickly share this with you guys. Boom, save this. And if you see, depending on the price action here of these macro charts, yeah, so this is a bigger picture, like you see industrial production is also a chart. Everything where you can have historical data, you can make a technical analysis. And so it looks like we are here at the top. You see more M's than W's here. So the industrial production should probably come down in the closer future. And also here, interest rates, 5 years, also called belly. You see that, depending on how the price moves or reacts here, we are in a different regime in the market. And currently I would expect on the bigger picture that we are in an early recession phase, but we are not at the recession. And so this you can then analyze based on the price action. If we are rising, then we are in the early recovery phase here in the industrial production. So we would be here early recovery, somewhere around here. And that's how I analyze the market. And you see also the blue line is the economic cycle, so like our real market, and the orange line is the stock market, like the market cycle, and the market cycle is 6 to 12 months ahead of the economic cycle. So if you see energy, materials, staples, and everything is outperforming, then you can, and you see them rolling down, then you will probably read in the newspapers and everywhere that the economy is pretty well, but you see it already in the stocks that they are coming down. And after the stocks come down, then you will see also the economy slowing down. That is the message of this chart here. And that is how you can analyze on the macro perspective the price development. And this is also if you see now in the, for example, discretionary or industrial sector or technology a few months ago, that here also on the chart list where you have to look at long-term, like monthly charts, and you see here communication services, whereas technology, here technology, no, this is staples, energy, financials, healthcare, industrials, technology. And if you see then that the technology sector on a monthly basis is actually moving up, and you see also the other sectors are rallying, then you can expect that we are in a market bottom and in the early bull market phase. And here is where you find the shovel sellers to the gold bugs. Yeah? So, because who made the most money in the gold rush time? Not the people who digged for gold. It were the shovel sellers. And that's how I detect in an early way a trend. If you see several sectors performing, what will hold probably also for a longer time, because this is a monthly chart, so very slow but very strong if you can detect a trend in this market. Okay, so was a little bit over just futures, guys, but I hope this explained you the main concept of futures and also your extra questions. And we will get next week into another very interesting concept for the future market. And there I also will explain a little bit more about the futures, and then show you how to use the commitment of traders report in combination with the commodities, what is a very, very strong and good concept actually. And the most or the best performers in the Robbins Cup trading competition or worldwide trading competition are generally future traders who use the COT report, like Larry Williams, who's the undefeated champion of the Robbins Cup over all the years. Yeah. So yeah, I hope you got some value today. It was a little bit rough at the beginning, and I will clean up the other videos. But yeah, future market is also my bread and butter. So that's why I love the future market. It is a quite actually fair market in my opinion. You have a lot of tools, which I also show you next week in combination with the COT report. And yeah, if you understand the future market, it is a very, very nice market to trade. Okay, guys. Then, yeah. So here's the term structure again for these commodities. And that's also something we can look next week again. But yeah. So I hope that I could answer all your questions, and yeah, too much value. You deserve it, guys. Thanks for your patience. And this is actually our standard, what we want to have here at TRI for sure. And yeah. All right. Then thanks for being here. Thanks for listening. And if you don't have anything, then the only thing left to say for me is bye for now.